Hello, today we are going to discuss about the capital budgeting. Capital budgeting is simply called as long-term investment, where you are going to invest your capital. There are certain techniques are available in the book, like first technique is given NPV, net present value. Second, payback rule. Third, discounted payback rule. Fourth, internal rate of return. Fifth, average accounting return. Sixth one, profitability index. These are the few techniques have been given in the book. But today we are going to discuss the most important technique, that's net present value. Net present value have a simple formula that NPV, net present value, is equal to present value cash inflow minus present value cash outflow. First we need to understand this formula. What is this? Present value cash inflow minus present value cash outflow. Present value cash outflow means whatever the project have a cost that you are going to invest right now, that's a present value cash outflow. Okay, and present value cash inflow, that we have supposed to determine the present value cash inflow. For example, let's discuss this problem first. If a project X cost $1 lakh at present, and we get the output at the end of first year, that's 15,000. At the end of second year, that's 20,000. At the end of third year, that's 25,000. At the end of fourth year, that's a 30,000. And fifth year, 15,000. Find the NPV. Discounted rate is 10%. Project cost $1 lakh. Okay, and what is the output and yield? First year 15,000, second year 20,000, total 35,000, 35, and third year 60,000, 60, 90,000, 90,000, and 1 lakh 5,000. Here we are going to invest 1 lakh and we are getting the return of 1 lakh 5,000 in 5 years. Find the NPV. If we have a NPV 0 or plus, then project will be acceptable. If we have a NPV plus, how it will be in a plus? I am telling you that formula is NPV is equal to present value cash inflow minus outflow. Outflow is given here, that is 1 lakh. Now we are supposed to determine the present value cash inflow. Inflow formula is given, that's PV is equal to FV divided by 1 plus I whole power n. 15,000, 1 plus I is equal to 10%, n is equal to 1. In the second year we are getting the output of 20,000, 20,000, 1 plus 10% discount rate, that's interest rate or discount rate, and number of years n stands for 2. 25,000, 1.10 interest rate or discount rate, and the year is third. 30,000, 1 point the interest rate is 10%, and the year is 4. 15,000, that is 1.10, and interest rate is 5. Okay, now if you will perform simple calculation, 15,000 divided by 1.10, you will get the output 13,636. Means the present value of 15,000 that you will get after 1 year, that will be 13,636.3. And 20,000 will have the present value. If you will change or discount the process, after 2 years, if you going to have 20,000, that's present value is 16,000. 25,000 have a present value of 18,000, and 30,000 have a present value of 20,000, and 15,000 that you are going to have after 5 years, that have a present value of 9,000. So if you make the summation of all these, that will be 78,756.7. That is what? That is a total of present value cash inflows, all the cash flows that we are going to get in the future after the first year, second year, third year, fourth year, and fifth year. If we follow the process of discounting, then we will find out the present value cash inflow, that will be 78,756.7, and present value cash outflow is 1 lakh. Okay, so here we get the NPVs minus 21,000. Okay, this project is not acceptable because it is in minus. If the same project, if I say if the same project costs us 75,000, for example here we have a 75,000 and present value cash inflow is 78,000, then it will be 3,000 plus, for example, then that will be accepted. But right now in this situation this project is not acceptable. Okay, I hope it is clear. Thank you very much.